Welcome to the InterMarket Analysis Update. This is being prepared Monday, September 5th on Labor Day. And I hope everybody has a really nice Labor Day weekend. And we'll look at the different interactions between markets and indexes to see how things look for Tuesday, September 6th. And this is a weekly video that I prepare. It's supposed to be in addition to the daily video updates that I do. Because those are so long, I take some of those charts and put them over into this separate video that doesn't update as often. So I only do it once a week, where we try to perform intermarket analysis. That's just looking beyond the S&P 500 to look at other markets, other indexes, and to get some footing as to where things are with the S&P 500. We first start by looking at S&P 500 valuation, and we still are considered to be overvalued. Now, this chart looks back. This is the trailing 12 months, and that's not what the stock market uses. They look forward, but this top dashed red line, that's the PE of 20. When we're above that, stocks are considered to be expensive, and we've been expensive for a long time now, and we're really far away from that chart, and that's what this different measurement shows down at the bottom. How far our price is away from being expensive. Well, we've been coming back down in 2022, and now we're kind of bouncing above and bouncing a little bit below the PE ratio of 20. Now, the market looks forward. They use forward earnings, and that's a little more in line, but we're having to keep an eye on that because we're seeing a lot of analysts out there start to lower their earnings per share looking forward. So if they continue to lower those estimates, then that will ultimately come through into stock prices. And if they're lower, that would justify lower prices. All right, here's another historical chart. Sorry about that. Going back to 1980, and it just shows how the S&P has performed over a period of time. And then you can compare that to when the stock market is considered to be expensive, fairly valued, or undervalued. The possible positive scenarios, because we're going down pretty strong right now, our daily charts are just not looking very good at this point, and we're seeing a lot more weakness coming back into our weekly charts. So I'm putting those on hold. I'm not talking about them in every video right now. In fact, some of these scenarios we're dropping so much that they may end up generating some new signals. But the idea behind these scenarios is that they help us to determine when the market's going to go up. Well, we're going down right now. Now, that could change at any time, but as of right now, I'm not really talking about those as much because they don't really fit what's happening. We'll look at growth versus value. Here's the growth index, which had been trying to come back and make some improvements. Well, it's been showing some weakness. The red line, which is the 200-day moving average, it's on top, and the 50-period moving average is on the bottom. That means that we're in an overall downtrend. So even though we saw some improvement here, the downtrend is really resuming. Then we look at the peer value index, and this is what folks tend to get into when they see more trouble on the horizon as far as the market is concerned. It's been showing some weakness too, but we're starting to kind of shift back to what most of 2022 has been. Getting out of growth stocks because they tend to really go down hard when the market goes down hard, and getting more into value stocks because they tend to hold up better, and some even advance. Some will still go down, but they may not go down as much as the growth stocks. Now we look at these together. This top chart is growth versus value, showing how growth has really been underperforming value, where the bottom chart is an inverse, and that shows how value has really been showing some improvements. Here's another way of looking at this. This is growth, where it had been trying to come back up, but now continues to show weakness, and we're down to the 50-period moving average in the ratio. This is an inverse of that same chart, showing how value is starting to break out a bit against growth. There's another way by using ETFs, also showing the same thing, where growth is really underperforming. And this is showing now that value is really starting to improve. Here's another index showing how growth had been trying to come back, but now is showing some weakness. So the rotations that we were seeing, the positive things that we're developing, those are starting to go away now as we wonder, okay, with the Fed really determined to combat inflation and raising interest rates, that really gets in the way of this whole growth scenario. And so we have to just go with that for right now. Looking at some other markets, these are the 30 biggest US software companies, and they had been bouncing back, but now they're showing some weakness because this is a growth area. The CRB index still shows, when you compare the inflation and deflation ratio, that this chart is suggesting that inflation is starting to come down. And that's what the market's trying to grab onto. We've done that a couple of times now where we see some weakness in the economic reports. They develop this scenario that maybe inflation is topped out, and now the Fed can stop focusing on raising interest rates and possibly even lower them. Well, we got faked out a couple of months ago. We got faked out coming up to the big speech that Chairperson Powell made in Wyoming. And then even on Friday, when things were going up in Friday's session, oh, it must be growth is coming back. I mean, anytime the market goes up, that's what they're using as justification that maybe inflation is starting to top out. Well, the Fed is not doing the things that they normally do. They're usually more accommodating to the market. And that's what's supposed to happen. The market should do what it wants, and then the Fed should follow. Well, that's not what's happening here. The Fed is actually leading. And so you've got these market participants, they're having to hang on everything that the Fed says or does. And it's going contrary to this idea that stock prices could go back higher. Now, at some point, is that going to lead to some problems? It could, where maybe the Fed overdoes it and they are so focused on raising interest rates that they're doing some real harm to the economy. And that could make them have to pivot at that time. But we don't know if or when that's actually going to happen. They're trying to have this soft landing where they get inflation under control without really hurting the growth in the economy. Well, with them raising rates over and over and over, eventually that's going to bleed through and probably have some economic fallout that now the Fed has to turn and focus on that. So, all right. Then we have this thing called the Baltic Dry Index, and that's the cost of transporting goods from one place to another, mainly the shipping costs. And when that costs more, this index tends to go up because it costs more and they have to put that into the price of their products. Well, lately we've been seeing how this has really been coming down. The CRB index is still in an overall uptrend, but has shown some recent weakness. And this is another inflationary gauge that we look at. And this is what the market's looking at. They're going, look, the CRB is coming down. The Baltic Dry Index is going down. We're seeing a lot of economic reports that are showing more weakness. Why is the Fed still so bent on raising interest rates? And that's producing a lot of the battle that's going back and forth right now. Where we look at things like corn, it had been lower, but it was up in this previous session. Aluminum also was bottoming out and now seems to be rising up a bit. It's bouncing around pretty much all over the place. Heating oil is still pretty high, but it's off of its highs. Gas has really been coming down. And this is probably the one that the politicians focus on the most because it's what everybody sees. It's what everybody has to deal with. And it's what everybody talks about, are gas prices. And we're coming up to a midterm election. And if they can keep gas prices lower, they feel that that might be of an advantage to them, whoever them are, whether it's one side or the other side. But natural gas is still staying rather high. Oil has been coming down and actually dropped below $90. We're at 86, 87 now. I have to clear my throat again. Sorry about that. I just don't have the ability to edit these videos. So once I get recording, I call them take one videos because I'm just doing it all in one shot. Wheat has been bouncing back up a little bit after it did spike. Lumber is also showing an overall downtrend lately. The dollar, this is what's really been going up. Now, the dollar may go in the toilet at some point in the future, but it's not necessarily right now. It's because the Japanese yen and the euro, they're having even bigger problems. And so you go to, okay, what's the best currency or the least crappy currency right now? And it tends to be the dollar. And it is still in a really, really solid uptrend. Then here's looking how the euro has been showing a lot of weakness as the dollar has been going up. Probably a good time to go to Europe if you so are inclined to do that. You get a favorable exchange rate. This is looking at the Japanese yen, which again has shown weakness, as has the euro, and the dollar has been showing some strength. Copper, which is kind of bouncing around, it was bouncing back up, but in this previous week, it's starting to come down. When it's going up, that tends to mean that the copper market thinks the economy is going to be better into the future. When it's going down, it means they see weakness in that market. So we look at the copper to gold ratio. You would think gold would really be going up right now with all the uncertainty and craziness that's going on, but it has really been underperforming these days. But copper has also been dropping as well. And here's a longer term chart showing the copper to gold or gold to copper ratio, how it's been falling. And there's a really big spread between the 2-year yield and the gold copper ratio. And we tend to see these closer to each other and they tend to move in the same direction, where now they're kind of going in opposite directions and they're not very close to each other. Gold, which did have a good day on Friday, has been in a pretty solid downtrend. And you have the gold folks out there that no matter what gold does, they justify it. Well, it's getting ready to break out. Maybe we're going to set a double bottom here. Okay, fine. There are people that really like gold, and there's a time for gold. But we have to look at the charts. We can't just twist everything around in our own mind to try to justify why something's going up or down. We have to say it's going up or down, and then we react according to what we see, not putting our own opinions into what we think is happening. Silver also bounced up a little bit on Friday, but is still in an overall downtrend. Looking at some indexes, the CRB has been starting to outperform stocks again. So we're still in an uptrend after it had been showing some weakness. Here's an inverse of that same chart where the S&P was trying to bounce back up, but since has been coming back down. Here's the NASDAQ 100, which is growth against the S&P 500. And the NASDAQ 100, after trying to come back up, has been showing some weakness. Looking at some other stocks, here's the mega cap growth. These are the really, really big, like the Apple and Google and the really big companies. They're starting to show some real weakness again and dropping below their 50-period moving average. The S&P 100, which is more growth oriented against the rest of the S&P, it's also underperforming and declining. Small caps, this is where we can get some potential strength from when they're going up. They're riskier companies or smaller companies. And so when people are feeling good about the rest of their investments, they might decide to get in a small cap investment. Well, now it's really starting to underperform. Low volatility stocks. These are stocks that tend to hold up better when we're in declines and we're kind of bouncing around. We had a death cross here, then we shot above the moving average. Well, now we're coming back down below the moving averages. So they're kind of chopping sideways currently. And here's the low volatility ETF ratio to the S&P, where it shows that the low volatility stocks are starting to show some improvement. This is the Dow, the transports, and the utilities taken together. Well, they're really starting to break down below the 50-period moving average. Here's Dow theory, where we see the Dow has been in a decline, the transports and the utilities, which have been holding up better, but they're still in an overall decline as well. This is just a longer term chart. We use this to look for any kind of divergences, either positive or negative, and I'm not really seeing much. Pure Dow theory just uses the Dow and the trannies, where I throw the utilities into the mix. And we can see over here, when you compare it to these other charts, how utilities, because they're more interest rate sensitive, they've been holding up much better. The FANG stocks, the really big tech stocks, they're really starting to show some weakness again, as is ARK. It's running into some problems. Looking at bonds, we thought we had a base here. We were coming up out of that, but bonds are starting to break down with the total bond ETF. And this is actually looking kind of scary. We're starting to go back down to the COVID lows with the world bond index. And if we break below this, because as bond prices go down, that means interest rates go up. And that could be pretty negative for the markets right now. This is a monthly chart of the stock to bond ratio. It shows that even though stocks have been struggling and bonds have been suffering, stocks have still been outperforming bonds overall. Here's bonds to stocks, which we saw a little bit of a spike up here. This measures different maturities than the previous chart. And we're trying to go back positive because the good scenario that we could latch onto that's not really developing is if bond prices go up and stocks start to go up. As bond prices go up, that would bring interest rates down, and that could be more of a positive backdrop for things. And the market kind of tries to start going in that direction, only to be brought back to what we've seen in most of 2022. Here's the correlation between stocks and bonds, and they're in a pretty solid relationship now where they're going in the same direction. So if bond prices are going down and stocks are going down, or if they're both going up together. Here's the Dow Jones Corporate Bond Index, which had been showing some improvement, but is now showing some weakness, even though it was up on Friday. Here is the S&P 500 to the 10-year yield, where the S&P had been underperforming the rise in interest rates, started to try to change that scenario, but now has gone back to that scenario again. Junk bonds. People get into these to get higher yields because even with interest rates rising, historically, interest rates are still very low. And so they might jump into a junk bond. Well, they've been showing some weakness as of late as well. And here's the junk bond ratio to the treasury bond, the riskier bonds against the not risky bonds, where junk bonds still continue to outperform treasury bonds. Here are yields where overall they have been really going back up, even though in Friday's session we saw a decline in interest rates. This is a weekly chart looking internationally. It just shows how the US, the UK, and Germany, their interest rates have really been going up. Japan is kind of its own separate scenario, and they've been trying to keep interest rates really flat there. Looking at some sectors where this is bouncing around too. These are staples, and these are things that people have to have no matter what's going on in the economy, like soap, toilet paper, toothpaste. Well, as the S&P started to recover, this was starting to come back down a little bit. Well, it's also starting to decline as well. So everything pretty much got hit in the past week. We also look at the energy sector, which has been going up, and they're really worried about, especially in Europe, what's going to happen to energy prices this winter with all the different political events that are going on, and with the pipeline being shut down, and they don't know, all these games going back and forth. That could really give some problems to Europe. And a lot of times Europe tends to precede what happens in the US. Well, energy is now starting to outperform the S&P 500, the tech sector, which came all the way up to its moving average and has been bouncing back down. That's growth. And semiconductors, another large part of growth, was starting to come back, but is now showing weakness. Tech to the S&P, it shows how tech is really starting to underperform the rest of the S&P. We have the growth area, which has really been struggling, and bond prices, which have really been struggling. And so they're just kind of bouncing around, pretty much going sideways currently. And we are seeing a recent golden cross here, but is this going to drop down below and turn that golden cross into another death cross? The 10-year yield, which has been going up against the tech sector, which has been going down, it was starting to change, but then we had the big old the speech that came out, and now things have really been turning back around here. And then this is an inverse of that same chart, showing how tech is really underperforming the rise in interest rates. Discretionary, the things that make life kind of fun, they've actually been holding up better. You see where they haven't dropped below the moving average? And the different rotation that we're seeing a lot of weakness in that rotation, but discretionary is hanging in there at this point. So we'll just want to keep an eye on that area as well. This is staples to discretionary, also not really moving as strong as some of the other areas that we're looking at. Here's energy to tech, shows that energy is now really starting to outperform the tech sector. Gold, which is really struggling, and stocks, which are really struggling. So we saw a little bit of an advance with the ratio, but it's still negative overall. And we're starting to see a potential death cross here. And this is gold to the dollar. The gold's been going down for the most part. The dollar's been going up. So that's why we're seeing this chart really decline. Then we have high leverage loans. These are riskier loans that can give you better returns, but when they really start to go down, that might mean there's some more fear on the horizon, and that's what they've been doing lately. Here's our intermarket analysis chart showing how oil has been up the strongest, followed by the dollar, and then we have gold, stocks, and bonds all negative going back to the beginning of the year. Looking at some indexes, this measures the American Stock Exchange, the NASDAQ, and the NYSE, looks at their highs minus lows, and then calculates a 5-period moving average. When we're above the zero line, that's positive. Well, we're starting to break down here. So on a broad basis, this is showing some weakness, but we're not necessarily extreme. This is potentially one of our scenarios that we put into play when we get a really extreme negative reading. We're not extreme right now, but it is showing some weakness. Small cap index also dropping below its 50-period moving average and really having some difficulties, as are the mid caps. And the Dow, just not a good week this past week. The NASDAQ also having some problems, as is the NASDAQ 100. The Wilshire, we're looking at this 50-period moving average right here. It acted as resistance before we really started to head lower in Friday's session. All stocks, they're starting to show some more weakness. Emerging markets never really did turn out all that positive, and they're starting to show more weakness as well. Internationally, China's starting to turn back up, even though there's a lot of pretty bad economic news coming out of China. They found some COVID cases there, so they're locking down at least one of their bigger cities. There's been some things in the news about what's happening in their real estate markets, and they could be running into some real problems. Now, that doesn't directly affect the U.S. stock market, but it can affect the U.S. economy because of the supply chain issues and eventually into some earnings with those companies that do business in China. Well, we're starting to roll over with the emerging markets, Europe, Japan, and the U.S. So China's starting to turn up while the rest of the world's turning down. Some correlations. This is the S&P 500 to the dollar, and they both ended up being down in Friday's session. They don't have as strong of an inverse correlation as they've been having, but it's still fairly strong, which just means if the dollar's going up, typically right now, the S&P would be going down and vice versa. Also looking at the S&P 500 to oil, they're starting to go in the same direction because oil's been falling and the S&P has been falling. So when we come above this 0.25 level, that means their relationship is more in the same direction rather than in the opposite direction. Here's the S&P to the 10-year yield. They have still a pretty strong inverse relationship. The tech sector to the 10-year yield also pretty strong with an inverse correlation. This is the S&P to the 2-year, also still pretty strong inverse relationship. So what are those things that are positive? This hasn't changed, folks. If you've watched more of these, energy's still going up, the CRB is going up, and interest rates are going up. Things that are negative, here's our whole list. And you can just pause this and look, and pretty much if you're not in one of those 3 positive areas, you're probably in one of these areas right here. We thought things were really starting to shift, but then when Chairperson Powell came out with that speech, that spooked the markets, and we've been kind of fighting on the defensive ever since. So thank you. I hope you found this useful. Please feel free to check out the daily video, and I've recently posted the weekly video. And I hope you have a really nice Labor Day, a great week, and I'll prepare this video again next weekend.